Welcome to The Real Deal, where it's all about real estate and related businesses in central Massachusetts and northeastern Connecticut. And now, your host, Anthony Shabbat of Shabbat & Associates.
Hey everybody, and welcome to the Real Deal Real Estate Podcast. My name is Anthony Shabbat of Shabbat & Associates Real Estate Group of EXP.
My name is Mario Kula from QS Private Lending.
Jay Lorette of Lorette Investment Group.
And on today's show, I'm happy to introduce Mario. He actually was one of the guest speakers at one of our recent multifamily meetups at Waterfront Mary's in Webster, Massachusetts. And it was a great turnout. We had about 35 people show up, from investors to attorneys to realtors to lenders to you name it. If they're in the industry, we like to all get together, get to know each other, build a relationship, and know who the go-to people are in the industry for future reference. So that's what we're going to do on this podcast. We're just going to have Mario pretty much take over the show. You guys can kind of run it a little bit like you did the other day if you want, while I'm kind of handling the technical details on this side. So Mario, why don't you take over and tell us a little bit about yourself, your background. Where'd you go to school? Where'd you grow up? How did you get into this career? And what types of things do you handle?
Yeah, thank you for having me. Really appreciate it. We had a great time at Waterfront Mary's, so I'm happy to come hang out on the podcast with you guys. So I got started in the industry about 3-4 years ago almost. I was raising money for the fund that funds our deals, and then we kind of had an influx of capital, and then they wanted me to originate loans and source deals, and so now that's what I'm doing, and became the senior loan officer and top producer for my firm. And we are essentially a direct hard money lender. We are a local lender, and we fund everything from fix and flips. We fund ground up construction. We do permittable land, bridge loans, really a lot of times unconventional stuff, so super distressed properties that lenders, more conventional lenders can't touch. Properties with time constraints, so if someone needs to close quick or they're at risk of losing a deposit, stuff like that, we can fund very, very quickly. And that is kind of the void in the market that we fill.
Great. So actually the other night when we first met up with you, it was Brian Allen was the featured guest speaker. He is, and I said it 100 times because I'm pretty proud of him. He said he's the number one multifamily agent in central Massachusetts. So he was the guest speaker at the event. Really knowledgeable guy. I've never seen any realtor that's more analytical than him. And he just recently joined with a group that you're familiar with, working with one of their other agents, Jeffrey Torres. Mm-hmm. So now you're probably going to be working a lot more with Brian. I asked Jeffrey if he wanted to be one of the guest speakers at a future meeting, and he doesn't seem like he's one of those people that wants to get in front of everybody and give a speech. But Brian has a lot of experience as a teacher, so he's really comfortable just standing in front of people and explaining things. But anyway, so just want to give people an idea, like the group that we work with. And so what has been your experience with working with Jeffrey Torres and their group over there, and central Massachusetts in general, and what states do you cover? I guess those are some questions.
Yeah, so Jeffrey Torres and Brian Allen and that group over there with Israel Furman, who's an amazing closing attorney that we utilize a lot. They've been great. I mean, they have really heavy hitter investors that are doing multiple flips, multiple investment properties at a time. The experience has been good. We've closed a lot of deals with them. I'd say in the past 6 months we've probably closed like 4 or 5 deals.
Okay.
And we've serviced Worcester County and Western Mass since inception, and there's really no limit to where we'll go in Massachusetts. But our 3 main states is Mass, Rhode Island, and New Hampshire. And then we also opened up a satellite office in Atlanta, Georgia. Mm-hmm. So we kind of service an hour, like Atlanta, and like an hour outside of Atlanta.
So unfortunately, you can't do Connecticut yet. Maybe at some point in the future, but
can't do Connecticut yet. But we can do Connecticut if there is an investor with, say, additional collateral in any of the 3 states or
Oh.
4 states that we lend in.
Interesting.
So if
Okay.
you're trying to buy,
Perfect.
a property in Connecticut and you have a multi in Mass or Rhode Island or New Hampshire that has real equity in it, we can certainly take a look at that and use that as additional collateral
That
to
actually-
be able to fund that deal.
That works out great because we actually one of the things that we were trying to focus on is getting investors from Massachusetts to come to Connecticut. So if they're investors in Massachusetts, they have collateral in Massachusetts, they can use you as their lender for Connecticut.
Totally. And then also I pride myself on being able to help clients even if I can't fund the deal. So like if I get a deal from New York or I get a deal from Connecticut where they don't have additional collateral or anything like that. I mean, I've been in the industry a while now and I've met a lot of really, really good people, but only a select few that I refer real business to because I'm very careful about, the reputation you get when you refer business. So you want to make sure you're always referring people to people that you would do business with as well. So I have those connections from being in the lending industry in general. So if you do, just want a connection to a real trustworthy lender in the states that I can't do, I'm happy to have a conversation and put the communication together on a joint email or a phone call or lunch meeting or whatever. And I've gotten a lot of borrowers funded that aren't necessarily in states or deals that I could fund, but being able to help people in any way is always good. And then hopefully they return the favor, or when they do have a deal that I can fund, they come back to me and they say, hey, look, you helped me out with that deal in Connecticut that you couldn't fund, but I have one in Mass, so I'd like to give you a shot. So it happens more than you think.
I think it was interesting at the meetup that you really spoke on, because there was a question, how many deals could you fund, and as long as you were making the payments and as long as you had a payment history with you, that's what your real main criteria was. I thought that was really unique, and I thought that was a really good sticking point that a lot of people were like, wow, I may have had some bad history, or I may have, something I'm going through, but as long as I have, that good relationship with you and good payment history, that deal goes through. And
yeah, we take really good care of all borrowers, but especially there is more flexibility allowed with repeat borrowers that have developed a relationship with us, that have payment history with us. Those are the ones that will get some form of flexibility that a first timer with us wouldn't necessarily get. So yeah, I mean, like you said, there's really not a limit to how many deals you can do with us as long as you can pay for them. That's the most important thing.
That seems important.
and that actually tailors into something that I want to touch on with lending in general, and that is where your lender's capital is sourced from. That's a real important point to note, and it's one of the reasons why we are so interest payment focused, is because of how we're funded. And so we raise our own capital, and that's very unique to this industry, where a lot of lenders don't raise their own capital. They have like a bigger bank that gives them a warehouse line of credit, or they're have connections to New York money, bigger banks, hedge funds, and you just want to be careful with those lenders because their money and their capital is not necessarily at their mercy. It's really at the mercy of the capital partner or the capital source. And so, for example, in COVID, we saw a lot of lenders, I'm sure a lot of listeners have experienced or know a friend that's experienced during COVID, a lender that could not perform or could not fulfill the commitment that they had made pre-COVID. And so we saw a lot of influx in deal flow from that, because those lenders with those capital partners basically were like, hey, it's COVID, we're going to be super conservative and you can't use our line of credit anymore. We're shutting it down for now.
Yeah, I did see that a lot actually. As soon as COVID happened, even like commercial lines of credit, people that were able to get loans no problem before, the commercial department at the bank wasn't even like answering phone calls for a while.
Yeah.
And then one of them over here was transitioning to another bank, and then so that was they were almost unavailable completely.
Yeah. So we picked up a lot of surplus of business as a result of that. We had other lenders, competitors even calling us saying, hey, you know, we've heard you guys are still funding. I'd love to take care of my client still, even though I can't fulfill the loan commitment. I'd love it if you could take care of them, and then at least I don't look like an asshole. You know, I mean, I don't look like an asshole.
That's our first swear on the podcast.
Oh,
ding, 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 ding. That's okay.
Hopefully we have a rather mature crowd listening, but
we don't have little kids listening to a hard money lender.
I would imagine, yeah. But
Is that why they call it hard money?
So yeah, I mean, they, you know, understanding how, like, the chain of funding and how it works is important when you're picking a lender, and it could be the difference of a little bit more expensive lender, but having that security and peace of mind that you're working with a local lender that raises their own capital, that is in charge of their own capital. And so all through COVID, we were funding construction, we were funding new acquisitions, we were picking up the slack of lenders that were, you know, screwing borrowers, and I think it definitely rose awareness about our company in general, because we really don't do any marketing. It's really all been built on word of mouth and relationships with realtors and brokers and guys like you. And, so
I definitely think it's important, like you said, to know where the money comes from. So if you have a loan out, is there any kind of pitfall if you have the money out from, like you said, New York money or hedge funds? If you already have a loan with a lender in that situation, is there anything that you should be cautious of? I mean, like you said, you don't want to, you know, looking forward and you're getting into loans, you want to know where they come from. But if you already have one, is there anything that you should be kind of cautious of in that situation?
It's hard to say. A lot of lenders might not tell you the truth about, you know, whether or not they source their own capital or they have capital partners that really can make the final call, because they don't want to worry you or anything like that. But you know, if you're already in bed with a lender, as some say, it will be hard to adjust terms or kind of, I don't know, switch modes at this point. But you know, hopefully they're still performing for you, and you know, I would say any sign of, you know, lack of commitment or lack of communication, those are certainly red flags. And you know, there are always going to be really solid, trustworthy lenders, and then there are always going to be the opposite. Your reputation in this business is everything, and so I would certainly urge you to continue making and posting reviews about lenders so that others don't fall into, you know, similar situations, and that also others can become connected to lenders like us. You know?
One thing I want to do before we go any further is actually just have you give your contact information to everybody so that they can reach you if they have any questions, if they're looking for, and explain a little bit about what hard money is too. Hard money.
So hard money is, actually, I'll give my contact information first. My contact information is, my email address is Mario, Mario, at qsprivateleendingllc.com. It's a long one, but again, it's Mario at Q as in quality, S as in service, privateleendingllc.com. And then my cell phone number, which is really the best way to get in touch with me, and also another great part about working with a local lender is that you'll always be able to get in touch with the same person on the phone, right? Like, there aren't many national...
Press 1 for Mario.
Yeah.
Press 2 for...
It's amazing how many national lenders are out there where, you know, you call and you get a different person every time. And it's really hard to reach that same person and get answers quickly. So my cell phone is definitely the best way to get in touch with me. 508, 654 9200. 508-654-9200. Call me, text me, hey, I saw you on the Real Deal podcast. I'd like to ask you a question about anything,
Right.
I'm always available for questions. I'm always available.
So who is the type of person that's going to be looking for a hard money loan?
We are investor-centric lenders. Hard money lenders are pretty much investor-focused. So people that are flipping, building, don't have the means to get conventional lending. So maybe they don't show a lot of income on tax returns. Maybe they're in the trades and they do a lot of cash. Maybe they don't have a great credit score or a credit score good enough to qualify. And so, they need to seek alternate financing methods. Anyone that needs to close quickly, that's, conventional lenders are usually like 30 to 60 days. Some of them are like 90 days. So it's pretty hard to be competitive in the investment market if you have like a mortgage contingency of like 30 to 60 days. I'm sure you both
Right.
have experienced
Yeah,
that.
sometimes, if you're submitting an offer on a property, somebody says, we have this thing available, it's going to be gone quick. What are you going to do for an offer on that? You got to definitely put your best foot forward, and if you can offer, quote, cash,
Right.
even though when you submit the purchase and sale agreement, it's got to be shown as a loan.
Right.
Because you want to have that ability for the private money lender to say, sorry, we can't do this deal after they go through underwriting, right?
Right.
So
I get that question a lot. They're like, hey, I got this borrower, or I got this buyer, and they're submitting a cash offer, but the proof of funds letter is coming from a lender. So like, how is this cash? It's a lender. So obviously you have an underwriting process, right? And the best answer I have for that is we are essentially a cash offer because we fund as quick as cash. And our cash is very similar to the buyer's cash, right? I do tell all of my borrowers to not put a mortgage contingency in there.
Oh, okay.
Typically. If it's, every transaction is different, some do, most don't. Because that way the seller isn't really worried. I mean, they're like, okay, they're working with a lender, but there's no mortgage contingency, so if he doesn't get the mortgage, then
You keep the deposit.
I keep their deposit. For the most part, where my specialty is being able to talk to the buyer about the property and do as much preliminary kind of underwriting
Yeah, in advance.
conversation in advance, so that I can really give you a pretty good idea of if there would be an issue, this is what it would be.
Yeah.
And if there doesn't seem to be an issue and everything is as you say it is, which is what I'm basing all of my information, all my decisions that I'm kind of making on the fly with a buyer on the phone is based on what they tell me and it being true.
So you don't really give out pre-approvals like Oprah, like you get a pre-approval, you get a pre-approval,
Yeah.
you get a pre-approval.
It's sort of, right? Because I don't want it to be hard to get a proof of funds letter.
Yeah.
But there's certainly a conversation that
There's
we
some
have
guidelines that you have to-
before we
yeah.
get to a proof of funds, just to make sure that we are all on the same page. If you tell me that this is a fix and flip that just needs some lipstick work, and then we get there and it's like half burnt down, that's an issue, right? But if you're representing it to me in a true manner, then I'm going to be able to make decisions based on that information you're giving me. And I would say 99% of the time I can come to a pretty solid conclusion within 24 hours easily. Usually it's just like same business day. My principal is really the final say of everything, and if there is some deal that doesn't seem to be vanilla, then I immediately, I have his direct line. I can call him anytime, and we have a quick convo, and he's like, well, tell them we would need X, Y, and Z in order to really be sure. And then others where it's like, hey, this is the deal. I want to put 10% down. I want to put 15% down, whatever. I need this much for construction. It's a great location. I have reasonable credit, and the ARV, after repair value, for anyone that doesn't know what that means, is X. And as long as the numbers work, because it's really all at the end of the day for lenders a function of numbers and a loan to value. And if it all falls in line, then we're good to go. And you can pretty much be safe to say that it would be a deal that we would do. And if we ever get, if we get to the commitment letter stage, you get the offer accepted, and we issue a commitment letter, that's a commitment to lend. I mean, we're not issuing commitment letters if it's not a deal that we're gonna do, or if there's a red flag, I'm gonna address it before we issue a commitment letter.
Do you require inspections from a licensed inspector, or is it just a contractor
No.
walkthrough? Or
Yeah, so we do everything in-house. Another advantage to working with local lender, typically, we do everything in-house. We have an in-house construction team. We have in-house loan servicing, all that stuff. So when you do commit to us and a loan, it is subject to a site visit. Not necessarily an inspection, not necessarily an appraisal. It's kind of like our form of all of that encompassed into one. And we're really just visiting the site and going over a construction budget if there is one, and just making sure that the numbers seem reasonable. You know, if someone's doing a roof, a 12,000 square foot roof for like $5,000, and that's what's on the budget, we're gonna address that with the borrower and say, what's the deal with this? Like that's not gonna work. Like, how are you gonna do that? Maybe the guy owns the roofing company and they're doing it at cost, who knows? But they better have an answer for it. And if they don't, and they're like, oh, that was a mistake, well then we either see if there's room to increase the construction budget, and then we're all good. Or if there isn't room in the numbers to increase the construction budget, then sometimes the borrower will need to contribute a little bit more than they were anticipating, just based on the numbers.
what is the typical percent down? Is there one? What minimum of 10 and typically up to 20? Or
Yeah, so minimum 10 unless there's additional collateral involved. You know,
Okay.
there are times when we've done 100% financing. If, so-and-so has a 3-family in Worcester that's free and clear and it's worth $300,000 and we can use that as additional collateral, then we, likely would not even need a down payment depending on the price of the property they're buying. But sometimes people will use additional collateral to offset the amount of upfront costs they have on the property they're looking to buy. So I've had people do 5% down with additional collateral. I've had 100% financing with additional collateral. If you don't have additional collateral, that's fine. Minimum would be 10% down, and that is dependent typically on location of the property, credit worthiness of the borrower. And when I say that, people get kind of scared, but we're not looking necessarily at the score as much as what is in your credit history. So like if you have a low score just because you're heavily leveraged on credit card debt because you do a lot of flips, that's understandable. That's something that a hard money lender can understand.
Yep.
That's not something that any other lender can understand.
Exactly.
I have seen that actually, where people that own a lot of properties, actually it affects their credit in
Totally.
a negative way. Yeah.
Totally.
Which you
And-
would think they'd have top-notch credit.
And a lot of what we're seeing right now is forbearances.
Yeah.
So savvy investors have put a lot of their cash flowing properties in forbearance because they're just kind of making extra cash flow, and it gives them a cushion in case their tenant doesn't pay during COVID or whatever. So we've seen a lot of that, and a lot of people don't understand that forbearances negatively impact your credit, like a lot. It's essentially like your mortgage is on hold and you're not making payments, so that affects your credit negatively. And banks, underwriters for other lenders do not like that at all. Hard money lenders, us specifically, we can understand why an investor would put a multifamily on forbearance, right?
Yep.
And so if that's the only negative thing on your credit, but your payment history is good, then we're good to go. I mean, we're really concerned, like I said earlier, with monthly payments. We want to make sure we're paid because our model is paying our fund of investors. So we raise capital through investors like you and me, and that don't want to necessarily purchase property,
That's a
but
good
want to
point.
be involved in, the secure industry of real estate lending.
That's a great point. You actually mentioned that at the meeting. I'd never even heard of this before, so it's the side of the business I've never seen.
Yeah.
You guys actually, so you can actually be somebody that's borrowing money to use for a flip or a multifamily purchase that you're going to renovate and do a cash out refi, right?
Yeah.
Or you could be an investor in your company.
Yeah.
And you don't have to worry about doing any of that stuff.
No. Yeah, if you've ever been interested in lending, potentially doing your own lending, there's a lot to it. It's kind of a sexy looking industry from the outside, but behind the scenes there's a lot of risk, and unless you're set up properly. So that's how we raise our capital, is through promising investors a specific return. Our return right now is just over 10%, and it's actually never been below 10%. It has always been, higher, kind of in the 11.5% range. But during COVID, we saw a decrease in return because our loan amounts were based on typically 20% down deals. We were being conservative. So basically all the deals we were doing during COVID were 20% down. And that for us means a 12% interest rate. Mm-hmm. And so if we have an influx of 12% interest rate loans, then the fund's return went a little bit down from like a 11.5 to more like a 10.5. But we've seen a rise now because we're starting to do more and more 10% loans, 15% down loans. And those interest rates are slightly higher, so they go up to 14% at a 10% down purchase. A 90% purchase would be a 14% interest rate, and then 15% down is a 13% interest rate. So for those deals, it brings the return of the fund up. But yes, anyone could be an investor in kind of the back end of our business if they don't want to either lend their own money or do their own fix and flips, and it's a really good opportunity to diversify portfolios. If you're heavily invested in stocks or bonds or mutual funds, you can diversify. We also are on the Fidelity platform, so people can take their tax deferred accounts and essentially self-direct them and invest them in our fund. So if they're tax deferred accounts only making them 6 or 7%, or conservatively 4 or 5%, they can self-direct and put it into our fund and make money that way. So, and you can accrue interest, you can take monthly dividends. It kind of acts like a money market. After a year, you kind of have to be locked in for a year. You can take it out with a small penalty within a year, but it's not meant for that. It's meant to be like what we call a make money while you sleep fund. Yeah. So you just kind of put it in there and you don't touch it, and then after a year you can debit it as much as you want, like whenever you want. There's no fees to withdrawing your funds. So it does kind of act like a high interest money market at that point.
I got a couple more questions. Yeah. I gotta run. Today was crazy, so I gotta run to another appointment. I have a couple more questions I wanted to get out. Do you have any more questions?
I was just saying, at the event, I know you called it mailbox money, and I thought that was funny.
Yeah.
The only other time I heard that was with Jose.
Bigger Pockets says it sometimes.
Yeah. But mailbox money, I thought was it's so lucrative to like attorneys to doctors that have all this money, and they're like, what do I do with it? So I thought that was funny.
Yeah.
So if I have a hard money loan from another hard money lender, can I get another hard money loan from you? Do I have to share with you the information that I have another hard money loan already? Can I get more than one from you at the same time?
Yes. So we touched on this a little before, but yeah, you can pretty much have as many loans with us as you can pay for. There is eventually like a monetary value cap, and that has to do with the size of our fund, which as of right now we stand at about 200 million in active loans. So any one investor can't have a certain percentage of the whole portfolio. So I think it's like 5% right now. So
200 million. Wow.
Yeah.
Pretty good. I've never heard that number before from a hard money lender share that information before. So that's
local lenders are typically not set up to scale like that and have that much out on the streets. So we certainly I would say have majority of the market share in the local market for the 3 states, Mass, Rhode Island, New Hampshire, for sure, which is good. It means a lot of people trust us. It means we have a local reputation to uphold. If we were doing not so great things with borrowers, you would hear about it. There's a lot of realtors that, everyone's connected kind of in this industry from I've learned, and especially on the local level. So people.
And the investor group is even more tight-knit because we actually make an effort to be in more communication than typical realtors do, from what I've seen. We all want to know each other. We all want to know what's going on, the latest deals. Like, I think I know probably a pretty good portion of investors and lenders in Massachusetts and Rhode Island and Connecticut. Actually, I stay tighter with those guys than I do with even regular realtors that I see. So it's kind of interesting. Yeah,
that size, that volume has to do with, again, how we're funded. So we continue to raise capital where other local lenders will just have like X amount of money and, say they have, $15 or $20 million in a fund between a few heavy hitter or high net worth individuals is usually how it starts. They aren't always looking for more capital. In fact, a lot of business models, that's not their model. They don't raise more capital. They just have 20 million and they lend it out, and when they don't have any more to lend, they can't do any more deals until some deals pay off, and then they can start sourcing loans again. So it's a model that isn't necessarily conducive to like making as much money as you possibly can or funding as many loans as you possibly can, but they usually have a very tight-knit like borrower base because they can only have X amount of borrowers in the pipeline at a time. So
you said the best way for somebody to reach out to you is by calling you on the cell phone,
right?
Yeah,
calling or texting. Usually a text first is nice because then I can actually strategize when I'm going to call you back, or I can text you and say, hey, are you available? I'd love to chat. But a phone call works too. Email works too.
What if I said, Mario, I want to buy this house, its address, send it over to you. Here are if it's a multifamily, here are the rents, here are the leases. Here's how much I have to put down. And then can you look it up and kind of give me an overview of how, yes or no? How long does that take?
Yeah, that's a same day. If you have all that information for me, that's a same day callback and decision.
Beautiful.
So there's
close
not
in 2 weeks on that?
There's not. Yeah, our typical time frame is actually 7 to 10 days.
Beautiful.
So we issue a commitment letter based on an executed offer that we see, or an accepted offer, or whatever, and or a PNS, and as long as the numbers make sense, we'll generate a commitment letter, and as long as you give us back the commitment letter, and we do require a $5,000 deposit, which before you're like, whoa, upfront costs. Everyone kind of has that knee-jerk reaction to upfront costs, but I'll explain a little bit about why we have an upfront cost, and that's because typically no one in this industry works for free, and if we're giving a commitment to you, we want a commitment back. Right, so I'm not going to give you a commitment and then go underwrite the whole loan only to have you shopping around the whole time and then decide to back out.
Yep.
And we actually, because we close quick, we utilize a lot of resources that do cost money in order to get it done for you. And so the deposit that you're giving is a deposit. It's not a fee, it's a deposit. And so you're entitled to it back if you don't do the loan. It's a fully refundable deposit.
Oh, okay.
Unless we've started underwriting, which is we get the go-ahead from the borrower. Before you start accruing any costs in the loan, we get the go-ahead from you. And if not, and you're like, hey, I want to lock this in, here's $5,000, but I'm going to continue to shop around, great, don't do anything on it yet, no problem. You've locked in the loan, you decide you found some better deal, no problem, we'll give you the whole $5,000 back. If we get to closing table and you're like, I'm not going to move forward with this loan, or there's a title issue that no one knew about, we used resources to find that stuff out for you, right? Attorney's time. We do a site visit. The site visits aren't free. Neither are appraisals, which we don't do, but we do a site visit. That's not free. those fees will come out of the deposit if you do cancel the loan.
So that's a good question. So basically, I call you up, I said, or text you, I said, here's the address, here's the leases, here are the rents, here's how much I have to put down on it, I want to close in 2 weeks on this. So you're going to get back to me and say that you can do yes or no on that one right away. And then how soon should I get the title search done? Like immediately, right?
If you have an attorney that's working, we let borrowers designate their own closing attorney. Mm-hmm. It kind of keeps the process moving quicker, and that way, if your attorney drops the ball, it's not on us. A lot of lenders do force you to use their own counsel or designate a certain attorney. We tried that model, and it works, but it also doesn't work. You create a lot of animosity sometimes between borrowers that have relationships with attorneys for a long time. Mm-hmm. Sometimes they don't charge them anything for the closing, and so they have a certain comfort level. And then if you designate an attorney, and that attorney may be the greatest attorney in the world, but if they potentially drop the ball in one aspect of the transaction, whether it's not getting back to them in a timely manner, or I don't know, something that's negative, right? It looks bad on us, right? We're the ones that made you use that attorney. We let them use their own attorney. So if you have your own attorney, we want them to obviously get started as soon as possible so that you can determine whether or not there's going to be title issues. I would say most PNSs, even for investors, are always subject to a clear and marketable title. Might not necessarily have a mortgage contingency, but definitely like a title contingency. So that way, if there is some issue that no one knew about, they're not at risk of losing a deposit, but they may be at risk of losing a little bit of money with us if they didn't know that beforehand.
Right, okay.
But that deposit, like I was saying, it is a deposit. It's not a fee, so that gets credited to the borrower in full at closing.
Oh, okay.
So it's almost like a prepayment portion of the closing costs that you're already going to incur.
All right. Well, I think I asked all the questions that I have. We should probably just wrap it up. Give your phone number, email address one more time.
Absolutely.
For everybody. So how do I give you a call and how do I text you?
So my email address is mario@qsprivatelendingllc.com, and my phone number is 508-654-9200. Again, 508-654-9200. I just want to add one more thing.
Yeah.
We do have an amazing referral program, and this business is all referral based. For real estate in general. I mean, as brokers, realtors, you know that, right? And so we do offer a similar program. So if you're not necessarily doing a deal right now, but you have a friend or you have a realtor that works with investors or anyone that you can put in touch with us that may do a deal, you can still get paid some money for that. And so that's a pretty powerful program. Our program is actually a perpetual referral fee. So if you send me Joe Schmo, the borrower, and he does 10 deals with me because he loved that one deal that we did, you're going to get paid on every single one. And so that's a powerful program because a lot of lenders will give you a referral fee, but only on the first one.
That's a pretty good referral.
You give me Jim, and then Jim does one deal and you get the fee, but then Jim comes back and they don't remember the guy that referred Jim from day one. And so
it's like when you're doing sales and then you provide a buyer, and then that buyer goes and buys a whole bunch of other stuff and you don't get a commission on any of that stuff. So it's awesome. Good idea on that one.
So any connections are good connections. If you have anyone that you think could benefit from this type of financing that we're talking about, and you put them in touch with me, that is a connection that you would be paid on technically if that person did a deal or that led to some business. And we keep very good track of that. We have a very, powerful CRM program, so no one's ever missed a referral fee that was due to them.
Great.
So
that's excellent.
Yeah.
That's good stuff.
I appreciate you guys having me on the podcast.
It's educational. You're the first hard money lender that we've had on the podcast ever, and I think a lot of people out there want to learn more about what is a hard money lender, how do I get involved in becoming an investor in multifamily or flip opportunities in Northeast Connecticut, Central Massachusetts, all that stuff. So give this man a call right here, and he'll set you right up. You just got to find a good deal and go after it.
Yeah.
I think it was funny. I went to one showing to an investor one time. I was showing, and we were talking after my client left, and he's like, "Oh, I've been an investor for this many years," and he says, "Explain this hard money thing that you guys were talking about." And he's like, "I've never heard of hard money lending before." And I looked at him and I'm like, "How long have you been an investor? And how deep has your investing gone?" Because it was just kind of funny that came up, and I just had to stare at him for a while and be like, "Really?"
Yeah. I will say it does have, it has had in the past carried a negative connotation, hard money lending, loan sharking as it used to be called, kind of. And it's come a long way. There are certainly lenders, like I said, that you want to just kind of watch out for and make sure. I would say my best advice for finding a lender is to find one through connections that you trust. For example, this podcast, these two gentlemen, right? You have a network. You're listening because you trust these gentlemen, what they're saying, and that is worth. It's priceless, actually, to make connections through trustworthy people. So I would always recommend using a lender that you can verify someone with credibility that has used them.
Yeah. Oh, yeah, huge.
Yeah.
Yeah, because you know they can get the deal done.
Right.
You don't have to worry about maybe this guy's not trustworthy because if your friend used him, he got the deal done, and he was happy with him.
Right.
It's been good to work with, and you know he's good.
Yeah. And also, one last thing, just always, they always say shop local. It's true in lending as well. You want to work with local money. You want to have an office to go to if there's an issue. You want to have, like I said, a contact that you can always reach out to, that you can, again, go to the office and see. And local lenders have a reputation, and that's important. National lenders, they don't care as much because, it's kind of a numbers game for them. They have the whole nation at their disposal. And so if one doesn't go well, they're like, on to the next one. And so we're more about building that relationship and continuing to have a local presence and a local reputation. So that's why you're going to get the better service and the quicker service. And it might come at a slightly higher cost, but if you're really only interest rate driven or cost driven, it's not smart, I guess you could say, right? You'd rather be, don't want to be penny wise and pound foolish, I think they call it. So it is always worth it to spend a little bit more and go with a local guy than not.
Yeah, that's huge. Even with, as far as I'm concerned, when you're working with local attorneys too, because the local attorneys in this area, they all work together, they know each other, they trust each other, they want to have a good relationship with the other attorneys. Sometimes I've had buyers from out of state that have an attorney that I've never heard of before, no attorney around here has ever worked with them before, and they don't really trust each other because they've never met each other. It actually causes problems sometimes. So I'd recommend getting, especially get a local attorney to be the closing attorney for your closing. And they'll work better together. Yeah,
and I've had people go with national lenders or cheaper lenders, right? Like whether it's 10% rate versus 12%. Okay, well, what's that 2%? What's the dollar figure on that 2% on a short-term interest-only loan where you're only paying money on the funds that as they're dispersed, right? Which could be minimal at start, and then as you draw construction, it increases a little bit. But find that dollar amount, because I've had people go that route, and then during the course of construction or during the course of the closing process or something, there becomes a hiccup and a headache, and that headache costs more than what that total 2% would have cost you per annum, and then you just offset your entire cost plus a headache, as opposed to just working with the right guy, the local guy from the start, not having a headache, and paying just minimal amounts more, when in the scheme of real estate investing, most deals have good, ample equity and value on the other end. So, I always tell people you want to be in make a buck mode, not save a nickel mode.
Yeah, that's a great point. Yeah.
Very important.
All right, guys, unfortunately, I have to wrap it up, but it's been a pleasure having you on here. I'm
Thanks.
sure we could actually continue this if you want to come back in 6 months, a year, something
Yeah,
like that.
be awesome.
Maybe we can have already done some other deals together,
Yeah.
but I have another appointment I have to get to. I'm actually running a little bit late for, but I just want to wrap it up. Thank you, everybody, for watching this episode of the Real Deal Real Estate Podcast. My name is Anthony Shabbat with Shabbat & Associates Real Estate Group of EXP.
My name's Mario Kula, Senior Loan Officer of QS Private Lending, LLC, out of Natick, Massachusetts.
And Jay Lorette of Lorette Investment Group.
Thanks again for watching, everybody, and have a great day.